How's it going, guys? Welcome back to another video. Thanks for tuning into Stock Essentials. My name is Alex, and today we're going to be going over AMC stock. As we can see, AMC is sitting at a nice price point of $57. Pretty flat in the market lately. As we can check the 1 month chart, it's been consolidating in this $55 range. So nothing exciting is really happening with this stock, so I'm just going to continue holding my 200 shares of AMC, as well as I am selling cash secured puts week over week in order to capitalize on the consolidation phase, because the more it consolidates, the more the premiums on options bleed out. But if you decide to buy call options, now could be a good time, because we're in this consolidation phase and we're just waiting for a nice breakout for any catalyst or some huge momentum that would be able to push the stock to sky high levels. So if you want to play call options, I would highly recommend not buying weekly options, not buying extremely risky strikes like 145. Those are lottery tickets. They're not very safe, but if AMC does happen to skyrocket, you're going to win it big on those options. But it's not for everyone, because you're not likely going to win on those options. They're basically lottery tickets, as we mentioned. So the options you want to play, it's very important to choose an appropriate strike price as well as an expiration date. So for expiration date, you don't want to do a month out or anything shorter than that. You're most likely going to lose in your options because AMC has been remaining pretty stable, pretty flat. Everyone's just holding their shares, because remember, AMC shares are owned 80% by retail investors, and a lot of them are just holding the stock and just waiting for that next big move. So we want to play options probably a few months out would be good. I would recommend the September call options if you're going to be playing options. So September 17th is a very popular one. As we check out the options chain, a lot of people are buying call options that are pretty far out, a few months out. September is going to be at least 2.5 months out, so it's going to give you a lot of time for your call options to play out. And the best thing about a further out expiration date is that time decay won't hurt your premiums as much as a shorter expiration date, which is why we highly recommend something like a September or later expiration date. Now for the strike price, you don't want to be too risky. You don't really want to buy the 145 strike calls unless you're just going to risk losing your money. Basically, the higher the strike price, the riskier it is, because you need a bigger move from the stock price in order to make a ton of money from the call options. So we would highly recommend choosing something at the money or below the money. The further down a strike price you get, the more accurately it will represent 100 shares, because the delta is going to be higher. As we can check the $55 calls, delta is going to be higher the lower the strike price, basically. And what the delta is for every $1 increase in the stock price. So if AMC goes to, say, $58, your premiums on the call options are going to increase by the delta times 100, because remember, each contract holds 100 shares. So if AMC goes to $58, this $55 contract is going to increase by $66. So it'll be worth $1,866 if AMC goes to $58. So that's pretty much how the delta works. So a lot of people are buying the September call options, September 17th specifically, for the $40 strike. This is a pretty far in the money strike price, so a lot of people are buying it just as a play, because after this consolidation phase ends with AMC, we're going to see a huge movement in price. Remember, the longer the consolidation phase, the bigger the price movement it will probably be. A lot of people are just anticipating holding their shares with cash on the sidelines, just waiting for the next momentum play. So you can check out how many people are actually buying these September 17 calls, $40 strike. And there is about $20 million worth placed into these call options. Open interest is pretty high, almost 42,000 contracts, which is insane. It's one of the most popular call options right now. A lot of people are buying it, and if we check it out on the options chain itself, we can see that there's good reason for it. So it's going to pretty much accurately represent 100 shares as close as possible. You're pretty much still leveraging your money, but instead of buying 100 shares, you could buy one of these call options for almost just under $2,400. So you're basically going to be leveraging 100 shares for half the price. So you could buy 2 of these call options for the price of 100 shares right now if you just outright bought 100 shares. So that's why call options, this specifically in the money, is a great alternative to buying shares. So the delta is going to be around 80. So for every $1 price movement in the stock price, you're going to be gaining or losing $80 on your contract's premium. And the theta is not that bad either. You're only going to be losing $7 a day to time decay. So this is why this $40 strike for September 17th is such an attractive options contract to play. As we can see, volume is pretty good, open interest is pretty good, and this is one of the call options that I would recommend buying. In the past, I would not recommend buying tons of call options because of the consolidation phase, but I think something like a September 17th would be pretty good. It's not too close to expiration. There's still a lot of time on it for your options to play out, and overall it's pretty, I'd say it's a good risk to reward, because we do think that AMC is going to squeeze in the next few weeks, next months, but we don't know when. So by doing a September expiration date, we're giving ourselves lots of time on these options, and overall it's just a really good play to make. But of course, as always, playing options, specifically buying options, is risky, so don't put in all your money into this options contract if you don't have a big account. For example, if you have only $3,000 in your portfolio, you don't really want to buy this call option because you're basically putting all your money into it. It's going to be pretty risky, so you have to understand the risk there. If you only have like $3,000, I would highly recommend just buying a few shares of AMC rather than buying something expensive like this call option that would cost you $2,400. So this is a great strategy to do for AMC while we are in the consolidation phase, because implied volatility is not as high as it is when the stock is actually moving. As we saw earlier, the implied volatility is only around 160% for those call options. So the premiums for those contracts aren't going to be that high, which is the perfect buying opportunity. You want to buy your call options. You want to buy options when implied volatility is lower, and implied volatility is at its lowest when we're seeing a stock remain flat like this, a nice flat line sticking around the $55 mark. So AMC is sitting at $57. It's holding its price point really well, and overall we're still really bullish on AMC. So I'm holding my shares personally, and I'm just occasionally selling weekly calls in order to capitalize on some time decay and weekly premiums. But that's about it for this video. If it helped you in any way, please leave a like, comment down below if you have any questions of AMC, and of course subscribe if you're new to the channel. It helps out a lot. Thanks for watching.